Good afternoon, I'm Brigid Taylor and this is Currency Wars. Let's have a look at the highlights in the past week. The Eurozone's Purchasing Management Index came in above expectations at 54 for March. This was the highest reading since mid-2014, with the new orders component surging to nearly 4-year highs of 54 and the employment component also gradually lifting. This helped to bolster the euro over the past week. Meanwhile, in the US, the February headline durable good orders contracted to negative 1.4%. That's versus expectations for a 0.2% January release. And these were also subject to steep downgrade revisions. This was driven by a stronger dollar, soft external demand, and adding to the pressure on the Q1 GDP tracking estimates. Meanwhile, this afternoon, the SARB rate decision today will be expected to be no change as Lesetja Kganyago's third MPC term at the helm comes to a halt. The US dollar rand 2% higher since January 2015 MPC and has dropped from a 2015 high of 12.51 on the 16th of March to current levels of around 11.80. On a trade-rated basis, the rand is only 0.9% weaker after marking a 1.2% gain against the euro over the period. However, inflation has softened to 3.9% year-on-year in February, and this is the lowest level since February 2011. This clearly reduces the pressure on the SARB to normalize the interest rate. Now that we've seen the lay of the land, I'm going to welcome my guests, Andre Cilliers from Treasury 1 and John Cairns from RMB. Thanks very much. It's not the end of Kganyago, so let's just make sure we get that right. But let's move on and just look at what's happening. I mean, it's been quite an interesting week again. We're looking at, we were saying just offset, there's talk again of what's happening in Yemen, worrying about global insecurities. Is it really such a big deal?
Yemen, I don't think so at all. I mean, Yemen's at the end of the Arabian Peninsula. They don't even produce any oil. Yeah. They're not on the Persian Gulf. Hard to see how stress there could impact supplies. I get the story that it's the broader Saudi, Sunni versus Iran, Shiite part of the battle. But I think it's been overblown. Oil's gone up to 59. I think we'll come back. I don't think that's a big story. Bigger story is still the euro dollar and the Fed.
No, sure. I think I agree with you. And I mean, we're looking at covering positions in this market, still looking for euro weakness with regards to the outlook for the eurozone. What are your feelings despite the fact that PMI came in so positively this week?
If I look at the euro, then I think the dollar's been too strong, the euro too weak. The decline of the euro, the rate was way too fast. I think people got ahead of themselves. Figures came out positively for the euro, negatively for the dollar. Technical retraction back to these levels. I think it will continue coming down again, but at a much slower pace. And I'm not calling for, like some people, 85 or something, but I think we could still get closer to parity levels. But as I say, the rate of decline will have slowed tremendously. Which gives some reprieve to the figures at this stage.
Yeah, the other big story there is the Fed's worry about the dollar. That was maybe for us in the currency markets, the really big news from the Fed statement. Expressing a little bit of worry, does that mean they're going to, dollar gains are going to stop them from acting, which in turn stops dollar gains? So, yeah, Andre, I'm agreed with you. We can probably eventually get down to parity, but for the moment, that pressure is eased off euro dollar. Yeah.
I think one should really say that. I mean, when during the last Fed meeting, the minutes came out when Yellen spoke and the release there. If you read that carefully, she's really just simply said to the people, "Listen, guys, stop looking at one figure. An economy looks at more than one figure," and that's caused this sort of retraction a little bit back.
So what is your feeling really? I mean, let's talk about where we sit, because there has been a lot of mixed data. So we're looking at commentary coming out that's saying US data is starting to slow down. We're not seeing the wage increases as significant as the jobless claims numbers. So we've all been worried about unemployment in the US, but those have come back to more sustainable levels. Inflation possibly going to go back up to sort of 2%. But the actual number of income or the amount of income that people are earning is still a concern. So in the US, do you think that this is something that's negative that the FOMC is keeping an eye on? And then also with regards to the Eurozone, do you think they're doing enough to bolster that economy?
Well, I mean, from the Fed's perspective, certainly they're looking at, as Andre said, a wide variety of data. It's exactly the contrast you mentioned, Brigid, is that we've got one strong figure, which is non-farm payrolls growth, which just happens to be the most important indicator for the global economy. Yet the other US data is weak.
Yeah.
So now, which of these two forces are you really believing? And so non-farm payrolls for the next few months is certainly very important. But the Fed's caught between contrasting data.
But they did put out, I mean, this is something we need to cast our minds back to. When Bernanke was still at the Fed, he talked about the two issues that they wanted to address to pull back quantitative easing, which they've done, and then potentially for interest rate hikes to come back on books. So the quantitative easing stopped when they looked at certainly when they looked at unemployment reaching certain scenarios, and then the inflation. So I think they're still a little bit concerned around inflation in the US. Is there that consumer demand? Is there that continued bolstering in the underlying economy? So I think, from an interest rate hiking perspective, that's certainly something they're going to be keeping their eyes on. What do you think in terms of the FOMC's view? I mean, you hear different scenarios. It's a bit of a political play, dependence on which individual you're listening to. But the overall trend still seems to be for that hiking, but with a very cautionary stance around the data. What other data will you be looking for specifically outside of non-farm payrolls?
So it's non-farm payrolls and then the associated figure that comes at the same time, which is earnings growth. And that's your earlier comment. Earnings growth is 2% at the moment. Wage growth, that's what it's been post-crisis. So there's absolutely no pickup in wage increases despite the unemployment rate.
And is that correlated to the inflation rate?
So the US economy works like your economics 101 textbook. Okay. As job growth picks up, wages start to grow, and as wages grow, you get inflation. So what you got the first part of the puzzle, unemployment's coming down. The second one is missing. There's no wage growth. So Fed's caught in this dilemma.
Yeah, I think if you look at what's happened in Japan, and as John now said, textbook 101, their prime minister went around to companies, literally asking them to increase the salaries of people in Japan. And people like Toyota has actually adhered to that and increased that. But as John says, they're going to recover that cost, they lift their prices, brings inflation, and that is where you get normalization of your interest rate policies and the rise in interest rates, etc.
So then, in my mind, it talks to watch inflation, watch the inflation numbers, watch the wage increase numbers, because those will be a good indicator with regards to how quickly we can expect to see the Fed step up to the plate, because they will want to be more preemptive than reflective in terms of making a decision. But let's look at the Eurozone. So let's move our eyes quickly over to the Eurozone, and let's talk about how the Eurozone's positioned right now with regards to the weaker euro. I mean, they are predominantly, especially the stronger states, are predominantly driven by a weaker euro because they rely on exports, etc. Does that speak to continued growth in the Eurozone or some form of recovery within the zone?
Yeah, definitely. So you've got quantitative easing. We had Mervyn King, the ex-BOE governor, talking at an RMB conference earlier this year. And his point about the ECB and the quantitative easing was their intention was to drive the euro weaker. And it's exactly as you say, get exports growing again. And the recent data out of Europe has been pretty good. Well, it's really been beating the US data.
So even if quantitative easing per se is not the answer, it certainly drives the exchange rate, which then drives other parts of the market. So let's bring it back home, because if we talk about unemployment and wage increases, one of the issues around inflation in South Africa, yes, it's sitting at 3.9. But we've got these big pressures that are coming through. If we look at what's happening again with government sector, union negotiations, we're looking at what's happening with Eskom at Medupe. All of these sort of things speak to quite significant pressure that could come through along the line again on inflation. So as much as we're at 3.9 now, we potentially could see. Do you think that although today we're going to expect to see the SARB remaining on a flat bias, do you think there's a potential hiking interest rate?
Oh, certainly. I think we're still in a hiking bias. We get Andre's point now, but I think it's just a matter of time before we get the next move. Assuming the US economy is fine, assuming the Fed hikes, is really just a matter of timing when the SARB's going to hike. So 3.9% inflation, we at RMB have got it going back above 6% by early next year. Oil prices have bounced, dollar rand's a bit higher, global food prices are higher, we've got electricity tariffs, we've got fuel prices coming through. We've still got inflation in the system. It's not major stress to hike at this stage with inflation so low. But later this year, a hike is still likely. Yeah.
Are you of the same opinion?
The Treasury is not immediately on, but look towards a very carefully worded statement this afternoon. Because there's quite some pressures coming back into the inflation rate with fuel hikes because of an exchange rate, because of oil price, because of levies. So look at a very carefully worded statement. The next move up, but I wouldn't say that there's immediate pressure, but towards the end of the year, beginning of next year, definitely.
Yeah, we've assumed a November hike in our forecast.
Yeah.
So.
Okay, so if we just want to wind it up in terms of central bank policy decisions, we're looking for the Fed to remain pretty benign for now, looking at that inflation number, looking for something with regards to wage increases that will speak to further inflation before we start seeing hikes out of the US. So that will keep the US rates pretty much contained. In the Eurozone, potentially in the short term, seeing some form of a rebound. Why? Just because we're starting to see some better data coming out of the Eurozone with their weaker currency. And in South Africa, the trajectory remains upwards with that risk of inflation increasing. So we're going to look at the lay of the land. We're going to look at where we're going on interest rates. I'm going to talk to you about your currency views, and I want you to please be specific with regards to the cross currencies as well. Okay, I'm going to start with you, Andre.
On the euro rand, as I said, I think a bit of a retracement, but the cross rate's still under pressure from the euro side. So I'm still calling sort of the 13.10, 13.15 is the upside, with the bottom end around about the 12.85 levels. Pound, somewhere between the 7.45 and the 7.75 levels. Dollar rand, I'm looking at levels between 11.75 and 12.10.
Okay, and you?
Yeah, so I've got to agree with all your ranges. Just to add to that the euro rand is possibly the main cross to watch at the moment, or the main currency to watch at the moment. Euro rand's been very stable. What's driven dollar rand is just movements in the dollar. If we can start to get rand gains, which we saw some of earlier this week, it will be euro rand that will be coming down. So we've got the 12.85 level, and then the 2-year low down at around 12.65. I don't think we'll get there, but if we can, that would be a major bull signal for the rand.
Okay, so just to wind up for the week, if you're an exporter, you need to take advantage of the levels once again, because we're seeing that dollar rally running out of steam. We're seeing the interest, well, certainly in the rand, potentially down between sort of 11.75 up to around 12.10. And then on your euro rand, watch that cross, because potentially we can try it as low as 12.75, and if not, lower it down to 12.60 if that does break. The pound rand, pretty stable, also looking for a slight strengthening bias. So all in all, the local currency look to strengthen in the week ahead. If you'd like to send any of your questions or comments, you're welcome to do so at CNBC Africa, #CurrencyWars410, or to myself at Brigid R. Taylor for your personal responses to the FX markets. Until next week, good luck in the trenches.